Harami is a two-candle pattern in candlestick analysis. The first candle is typically long, and the second candle has a small body. Moreover, the second candle is generally of a color opposite to that of the first candle. The Harami pattern indicates the potential for a trend reversal. There are two main types of Harami patterns, the bullish Harami and the bearish Harami. As the name suggests, the bullish Harami is a bullish pattern that appears at the bottom end of the chart, evolving over a two-day period, similar to the engulfing pattern. In this chart, the bullish Harami pattern is encircled. The thought process behind a bullish Harami pattern unfolds as follows. The market is in a downtrend, pushing prices lower, giving the bears absolute control. On day one of the pattern, a red candle with a new low is formed, reinforcing the bear's position. On day two of the pattern, the market opens at a price higher than the previous day's close. This unexpected high opening price causes bears to panic. P2 gains strength, closing positively just below P1's open, forming a contained blue candle within P1's long red candle. The small blue candle, though seemingly harmless, causes panic as it appears unexpectedly. The blue candle encourages bulls to build long positions, unnerving the bears. The expectation is that panic among bears will spread, giving a greater push to bulls, pushing prices higher. Hence, one should consider going long on the stock. The trade setup for the bullish Harami is as follows. The idea is to go long on the bullish Harami formation. Risk takers can initiate a long trade around the close of the P2 candle. Risk takers can validate conditions to confirm if P1 and P2 together form a bullish Harami pattern. The opening on P2 should be higher than the close of P1. The current market price at 3:20 p.m. on P2 should be less than P1's opening price. If both conditions are satisfied, one can conclude that both P1 and P2 form a bullish Harami pattern. The risk-averse can initiate a long trade at the close of the day after P2, only after confirming that the day is forming a blue candle. The lowest low of the pattern serves as the stop-loss for the trade. Here is a chart of Axis Bank. The bullish Harami is encircled. The OHLC details for the pattern are as follows. P1, open equals 868, high equals 874, low equals 810, close equals 815. P2, open equals 824, high equals 847, low equals 818, close equals 835. The risk taker would initiate the long position at the close of P2, which is around 835. The stop loss for the trade would be the lowest low price between P1 and P2, which in this case, it is 810. The risk-averse will initiate the trade the day near the close of the day after P2, provided it is a blue candle day, which in this case is. Once the trade has been initiated, the trader will have to wait for either the target to be hit or the stop loss to be triggered. Here is a chart where the encircled candles depict a bullish Harami pattern, but it is not. The prior trend should be bearish, but in this case, the prior trend is almost flat, which prevents us from classifying this candlestick pattern as a bullish Harami. And here is another example where a bullish Harami occurred, but the stop loss on the trade triggered a loss. The bearish Harami pattern appears at the top end of an uptrend, allowing the trader to initiate a short trade. The thought process behind shorting a bearish Harami is as follows. The market is in an uptrend, placing the bulls in absolute control. On P1, the market trades higher and makes a new high and closes positively, forming a blue candle day. The trading action reconfirms bull's dominance in the market. On P2, the market unexpectedly opens lower, displaces the bulls, and sets in a bit of panic to bulls. The market continues to trade lower to an extent where it manages to close negatively, forming a red candle day. The unexpected negative drift in the market causes panic, making the bulls unwind their positions. The expectation is that this negative drift is likely to continue, and therefore one should look at setting up a short trade. The trade setup for the short trade based on bearish Harami is as follows. The risk taker will short the market near the close of P2 after ensuring P1 and P2 together forms a bearish Harami. To validate this, two conditions must be satisfied. The open price of P2 should be lower than the close price of P1. The close price of P2 should be greater than the open price of P1. The risk-averse will short the market the day after P2 after ensuring it forms a red candle day. The highest high between P1 and P2 acts as the stop-loss for the trade. Here is a chart of IDFC Limited where the bearish Harami is identified. The OHLC details are as follows. P1, open equals 124, high equals 129, low equals 122, close equals 127. P2, open equals 126.9, high equals 129.70, low equals 125, close equals 124.80. The risk taker will initiate the trade on day 2, near the closing price of 125. The risk-averse will initiate the trade on the day after P2, only after ensuring it forms a red candle day. In the above example, the risk-averse would have avoided the trade completely. The stop-loss for the trade would be the highest high between P1 and P2. In this case, it would be 129.70. Thank you for watching this video. If you have any doubts or questions related to trading, feel free to reach out to us on WhatsApp at this number. And if you haven't subscribed to our channel yet, please consider subscribing. We'll be back soon with another insightful trading lesson. Until then, have a wonderful day.